In 10 minutes from right now, you are going to understand something that took most Americans decades to figure out. Something that Wall Street spends billions of dollars making seem complicated. Something that schools never teach, and banks hope you never truly grasp. The stock market, the two words that make some people extraordinarily rich and leave others completely paralyzed with confusion and fear. Today, that changes. Because once you understand how this machine actually works, once you see the engine beneath the hood, you will never look at money, wealth, or your own financial future the same way again. Let us start at the very beginning, because the stock market did not begin with computers. It did not begin with Wall Street skyscrapers or television tickers or digital trading apps. It began with a problem, a very old, very human problem. Imagine you have an idea, a brilliant idea. You want to build a ship that will sail to distant lands, carry goods, and return with treasure that will make everyone involved very wealthy. But building a ship costs more money than you have, more money than any single person can easily gather. So what do? You find other people who believe in your idea, you divide the ship into pieces, shares, and you sell those pieces to investors who want a portion of the treasure when the ship returns. If the voyage succeeds, everyone profits in proportion to the share they own. If the ship sinks, everyone loses their investment together. This was the first stock, born not in a trading pit but in a harbor, in a conversation between people with vision and people with capital. The Dutch East India Company formalized this idea in 1602, becoming what historians widely recognize as the world's first publicly traded company. It issued shares to the public, and those shares were bought and sold in what became the world's first stock exchange in Amsterdam. The idea was so powerful, so elegant, so perfectly matched to human ambition, that it spread across the entire world and never stopped. Today, the New York Stock Exchange alone handles transactions worth trillions of dollars every single year. But the fundamental idea is exactly the same as it was in that Amsterdam harbor 4 centuries ago. People with ideas, people with capital, and a marketplace where they meet. So let us define precisely what a stock actually is. When a company wants to grow, wants to build new factories, hire more people, develop new products, expand into new markets, it needs capital. It needs money. One way to get that money is to borrow it from a bank, from bondholders. But borrowing means paying interest. It means carrying debt, and debt has limits. The other way is to sell ownership, to divide the company into millions or billions of tiny pieces and offer those pieces to the public in exchange for cash. Each piece is a share of stock. And when you own a share of stock in a company, you own a proportional piece of that company. Its assets, its future earnings, its growth, and yes, its losses. When a company does this for the first time, when it offers its shares to the public for the very first time, it is called an initial public offering, an IPO. This is the moment a private company becomes a public one. The moment ordinary investors get the chance to own a piece of a business they never could have invested in before. When Apple went public in 1980, its shares were priced at $22. If you had invested $1,000 that day and held on through every crash, every panic, every moment of doubt, that investment would be worth millions today. Not because of luck, but because Apple grew. And as the company grew, so did the value of the ownership stake that each share represents. This is the core promise of the stock market. Companies that grow become more valuable, and the people who own shares in those companies share in that growing value. It sounds simple because at its core it is, but now let us talk about what actually happens inside the market every single day. Because this is where most people get lost. And getting lost here is precisely what the financial industry profits from. After a company goes public, its shares trade on an exchange. The New York Stock Exchange, the NASDAQ, and others. These exchanges are essentially marketplaces, like a farmer's market, but instead of tomatoes and bread, The product being bought and sold is ownership in companies. Every transaction requires a buyer and a seller, someone who believes the share is worth buying at the current price, and someone who believes it is worth selling. The price of a stock at any given moment is simply the price at which the most recent transaction occurred. It is not a mysterious oracle of a company's true value. It is just the last agreed price between a willing buyer and a willing seller. And because millions of transactions happen every single day, prices move constantly, ticking up and down in response to every new piece of information, every rumor, every earnings report, every economic data release, every geopolitical event, every tweet from a CEO. This constant movement is what most people think of when they think of the stock market. The flickering numbers, the red and green arrows, the breathless commentary on financial television. And it is precisely this surface layer, this noise that distracts most investors from the deeper, quieter reality underneath. Because here is what the price of a stock in any given moment does not tell you. It does not tell you what the company is actually worth. Price and value are not the same thing. They rhyme, they dance together, they pull toward each other over time. But in the short term, they can diverge wildly. And understanding that gap, the gap between price and value, is the foundation of every serious investment philosophy ever developed. Think of it this way. Imagine a business in your town that generates $100,000 in profit every single year, reliably, year after year. What is that business worth? It is worth more than $100,000 because you are not just buying this year's profit, you are buying all the future profits, discounted back to today's value. You are buying a stream of future income. This is called intrinsic value. And every serious investor, from Warren Buffett to the most sophisticated institutional fund manager, is ultimately trying to answer one question. Is the price I am being asked to pay for this company higher or lower than its intrinsic value? If the price is lower than the value, buying it is potentially a good investment. If the price is higher than the value, you are overpaying, regardless of what the stock ticker says. Now let us talk about the forces that move markets. Because understanding what drives stock prices up and down is the difference between being a rational investor and being an emotional one. And being emotional in the stock market is almost always expensive. The most fundamental driver of stock prices over the long term is earnings, corporate profits. When a company earns more money than investors expected, its stock tends to go up. When it earns less, the stock tends to go down. This seems obvious, but the mechanism is more subtle than it appears. Stock prices are not just a reflection of what a company is earning today. They are a reflection of what investors collectively believe the company will earn in the future. The stock market is a discounting machine. It is constantly trying to price in future events before they happen, which means that by the time good news is announced, the stock price may have already moved, because sophisticated investors anticipated it months earlier. This is captured in one of the most confusing phrases in all of finance. Buy the rumor, sell the news. It means that prices often move in anticipation of an event. And when the event actually occurs, the price moves back, because the expectation was already priced in. This counterintuitive reality is why investors who only respond to headlines almost always arrive too late. Beyond individual company earnings, the entire stock market is influenced by the broader economy. Interest rates, inflation, employment, consumer spending, GDP growth. These macroeconomic forces create the water in which all companies swim. And when the water gets rough, when interest rates rise sharply, or inflation surges, or unemployment spikes, even good companies swimming hard can lose ground. Interest rates deserve special attention because their relationship with stock prices is one of the most important dynamics in all of investing. When interest rates are low, borrowing is cheap. Companies can borrow money to invest and grow at minimal cost. And investors, finding that bonds and savings accounts pay almost nothing, pour money into stocks in search of better returns. This drives stock prices up. When interest rates rise, the equation flips. Borrowing becomes expensive, growth slows, and suddenly bonds and savings accounts begin paying meaningful returns, which means investors no longer need to take the risk of stocks to earn a decent return. Money flows out of stocks and into safer instruments, and stock prices fall. This is why the Federal Reserve, the central bank of the United States, is watched so obsessively by every investor in the world. Every word that comes out of a Fed meeting has the potential to move trillions of dollars of stock market value in minutes. Not because investors are irrational, but because interest rates genuinely affect the math of every investment on Earth. Now let us talk about crashes. Because no explanation of the stock market is complete without confronting the terrifying, inevitable, absolutely necessary reality of market crashes. The stock market has crashed many times in its history. The Great Depression, Black Monday in 1987, the dot-com bubble in 2000, the financial crisis of 2008, the COVID crash of 2020. Each one felt in the moment like the end of something, like a system breaking beyond repair, like a signal to get out and never come back. And each one, every single one, was eventually followed by a recovery that surpassed the previous peak. Not always quickly. Sometimes the wait was agonizing, but always in the long arc of market history, prices recovered and moved higher. Because the stock market is not just a gambling casino. It is a reflection of human economic activity. And human economic activity, driven by innovation, by ambition, by the relentless desire to solve problems and create value, has a long-term upward trajectory. But here is the brutal truth about crashes that no one tells you. Crashes do not hurt everyone equally. They hurt the people who sell at the bottom and reward the people who buy there. A crash is not a destruction of wealth. It is a transfer of wealth, from the fearful to the patient, from the emotional to the disciplined, from the people running away from low prices to the people running toward them. Warren Buffett's most famous advice is not complicated. Be fearful when others are greedy, and greedy when others are fearful. This is not a cute aphorism. It is a precise description of how wealth transfers during market cycles. The crowd panics. The patient investor buys their shares at a discount. The market recovers. The patient investor is richer. The crowd has locked in their losses. Understanding this does not make it emotionally easy. Standing in the middle of a crash and buying more feels like walking into a burning building. Every instinct screams to run, which is precisely why so few people do it, and precisely why the ones who do are so richly rewarded. Now let us talk about indexes. Because if there is one concept that makes the stock market accessible to ordinary investors, this is it. A stock market index is simply a way of measuring the performance of a group of stocks. The most famous is the S&P 500, which tracks the performance of 500 of the largest publicly traded companies in the United States. When someone says the market was up today, they almost always mean the S&P 500 was up. It is a snapshot, a composite, a temperature reading of the broad American economy. And over long periods of time, the S&P 500 has returned an average of approximately 10% per year, including dividends, including crashes, including recessions, including wars, including pandemics. 10% per year, on average, over the long run. This number is so powerful that it almost sounds fake. But it is the result of human ingenuity and economic growth compounding over decades. And the most astonishing thing about it is that you do not need to pick stocks to capture it. You do not need a financial advisor or a sophisticated strategy. You simply need to buy a fund that tracks the index, hold it, and not panic. Index funds were invented by John Bogle in 1976. The financial establishment called them a terrible idea. Why would anyone settle for average returns when they could try to beat the market? But here is what the establishment did not want to admit. The vast majority of actively managed funds, funds run by professional stock pickers with teams of analysts and decades of experience, fail to beat the index over any long period of time. Not occasionally, consistently, year after year, decade after decade. The index wins not because it is brilliant, but because it is cheap and consistent. No fees eating away at returns. No emotional decisions causing mistimed trades. Just the quiet, relentless compounding of the broad market's growth. Year after year, decade after decade. This is the secret that democratized investing. The insight that you do not need to understand every company or predict every market movement to build real wealth through the stock market. You need time, patience, regular contributions, and the discipline to do nothing when everything inside you is screaming to do something. The stock market, at its core, is a machine that converts the growth of human civilization into personal wealth. Every company listed on an exchange represents people working, creating, solving problems, building products that other people want to buy. When you own shares in those companies, you own a piece of that human creative energy, that ambition, that innovation. You are not betting on a number going up. You are participating in the ongoing project of human economic progress. And human economic progress, despite every setback, every crisis, every moment of doubt, has never stopped. The stock market is not the enemy of ordinary Americans. It is the most powerful wealth-building tool ever created. The tragedy is not that it exists. The tragedy is that so few people understand it well enough to use it. Fear and confusion are expensive. And clarity, the kind of clarity you now carry, is worth more than any stock tip, any market prediction, any financial product ever sold. You now understand what a stock is, what drives prices, what crashes mean, and what the simplest, most powerful strategy for capturing the market's long-term returns looks like. In 10 minutes, you have learned what took most people a lifetime. The only question left is what you do with it.